Hi, everybody. Welcome to today's webinar. We're here today with Mikko Suononlahti. We're going to discuss today fast track to Series A investment and how to pitch in front of investors. I am Perrine. I'm project manager at the European Business and Innovation Networks Center, the EBN. The EBN is a partner of InvestHorizon, which is a project financed by the European Commission and Eureka. We work as a consortium of 6 partners. We were launched last year in June 2019, and we work as an accelerator with the capacity to host up to 500 SMEs until the end of 2021. Please note that our accelerator application platform is always open, and we have cut-offs every 3 to 6 months. The next cut-off, the next selection, is on July 30th. Each company spends about 4 to 6 months in our accelerator. The key criteria for you to know is that you need to be a company in a deep tech sector looking for a Series A investment, which is set at 2.5 million. You have already secured a seed funding, and you are based in an EU country or in a Eureka country. Once you join our accelerator program, you are divided into online groups where you work together with your peers and expert coaches in online sessions in order to develop and improve your financial strategy. In the last part of the accelerator, we put you in contact with European VCs, and you have many opportunities to pitch your business. This is a screenshot of our accelerator platform where you can find all the information you need. Just a quick word about all the resources we have on our platform. We have free online classes on very different topics addressing industry and financing and market. And we also organize these webinars on a monthly basis. So today is our last webinar before the summer break, but we are already able to announce the next one after the break on exit strategies. So have a look at the website. You can already register. And we have an introduction webinar about the accelerator program on July 7. So if you're interested by the program, register to the webinar to get all the information. I'm here today with Mikko Suononlahti. Mikko, maybe you correct how I say your name. I'm sorry about that. Mikko, I'm very happy to have you here today. Mikko has been involved in the InvestHorizon accelerator for a while now. He's a very long-term expert in investment and technology, working together with startups, helping them to scale. So he's going to introduce himself in a minute. Mikko has a presentation in 2 parts. The first part of the presentation is dedicated to the key steps you need to have to get to Series A. And the second part of the presentation is dedicated to your investor presentation, what you absolutely need to include in your investor presentation. So before we start with Mikko's presentation, as usual, we want to know who you are and who is in this room today. So I'm going to give you, I'm going to ask you first who you are. So please take a second to answer this question. Give you a second. So tell us if you are an entrepreneur or an innovation expert. Please take a second to answer, and we're going to show the results now. Okay, thank you. Okay, yeah, as usual, most of the audience are entrepreneurs and scaling up. So it's good to know. Second question and last question, have you already pitched to investors? Yes or no? It's easy. Giving you a second to vote. Waiting for the results. Okay, interesting. Yes. So Mikko, this is it. You have the floor.
Thank you, Perrine.
I'm gonna, yeah. You may start sharing your own screen.
Yes. And let's just double check that you are seeing the screen.
Yes. As we agreed, I will give you a heads up once you have 5 minutes left for the first part of your presentation.
Right. And are you able to see my screen now?
No, we will see your desktop.
Okay. I need some assistance to get to the presentation.
Okay, Marta, can you take this over?
Yes, wait a second. You have two screens, right? You should share the second screen. Otherwise, I can share on my computer.
Okay, if you can, because I had, there we go. How about now?
Yes, it's okay. Good.
Are you able to see my screen now, please?
Yes.
Yes.
And it should be in, and it should be in full screen mode now.
Yes, perfect.
Yeah.
Great. So thank you, Perry. Thank you, Marta. And welcome everybody to the webinar. As Perrine said, I will be actually going through two separate presentations, but they tie into each other. And as about 2/3 of you have already pitched, I think what you will be getting from me, even though I'm just skimming the surfaces, is a framework which I think you will find useful going forward when you start to raise your Series A round. I'd like to make this presentation under what is called Chatham House rules. And what it means is that you are free, of course, to use the presentation. You'll get a copy of it. But the only thing that I'm asking for is please don't publicly quote me in newspapers or radios or whatever, especially if I mention some of my own portfolio companies, and I will be using some real life examples from their actual presentations. Please don't directly quote me or the names of my especially the names of my portfolio companies, which then allows me to be a little bit more liberal with the examples that I'll be going over. Thank you for that. Moving forward, the last time I did this presentation with the same organizers was in November 11 in Milano. It was a face-to-face event though, and the previous day I read a newspaper article about OpenText buying a data security firm called Carbonite for $1.42 billion. And as it happens, Carbonite was my pre-revenue investment from 2006. I led a $3 million funding round, and I took half of that for a venture capital fund, 1.5 million. And you can see how the financial history of Carbonite went from pre-revenue stage. You can see how much money they've raised. You can see their post-money valuations. You can see their revenue development. You can see their profitability, even though they were not making a profit. And then they did an IPO in 2011, and last year in 2019 they were then acquired as a public company for 1.4 billion. This is one of my 4 big success stories that I've invested in, but it just shows to you that the faster you grow, the more capital you will be needing, and you may be needing 2, 3, 4, 5, 6 funding rounds in order to generate shareholder value of in the hundreds of millions or in the billions. And my big point here really is that, hey, it can be done. There's a certain structure to it, and there are some certain frameworks to it. And I'm going to share with you pretty much everything that I've learned, having worked with entrepreneurs for more than 35 years, since 1983, on how to get there. A little bit about me. I take risk professionally as an early stage, pre-revenue stage investor, and I take some risk also during my time off. There's a couple of pictures about me from my hobbies. I'm not going to go any deeper into that. But during the last 25 years, I've served on the boards of 100 plus or minus venture capital backed companies in the US and in Europe. And I've gone through about 5,000 investor presentations. So the framework and the first presentation that I'm sharing with you, they're all based on a simple little thing, which is my 25 years experience doing this. In addition to Carbonite, which I mentioned, I had another pre-revenue stage company file for an IPO in the US for a valuation of about 300 million. And then two of my pre-revenue stage companies in Finland, already back in the mid 90s, they were acquired for 20 times the money that VCs invested. So every million that I invested through a fund or other VCs invested through a fund, we were able to get 20 million out from these companies. So what I'm going to start with, and Perrine will be keeping a time clock, and she'll be telling me when there's about 5 minutes left with the first presentation, and then we'll move on. But what I'm going to talk about next are my 10 general observations on what does it need to get to Series A funding. And one of the key points that I'm mentioning here is that there's a link between the investor presentation and fundraising and board meetings and exit. So it's the interrelationship of all of these. Especially what I'm going to emphasize is the link between the investor presentation and the financial plan. But we'll be coming and covering that topic more a little bit later on. When I speak about financial plans, I immediately start to think of CRMs, your customer pipeline, your sales pipeline, your marketing pipeline, and it's based on the CRM that I start to think about financial models, profit and loss statements, KPIs, OKRs, and valuation of the company. So what I try to do is through numbers, come up with a valuation, but my numerical analysis starts from the CRM. For the financial model, we will be going through real life examples on what kind of a financial model you should show in your first presentation. But behind that simplistic slide, you need to have an income statement and a balance sheet and a working capital calculation and a cash flow calculation and a hiring plan in order to come up with high level communications for a VC. And then think about what is the fully funded need that you need to get to an exit or to a break-even situation. I mentioned Carbonite. For them, it was 6 financing rounds over 5 years. And typically, I would say it's 2 to 4 rounds during 3 to 5 years, and you raise between 10 to 40 million in order to generate that shareholder value of hundreds of millions or even more. On exits, M&A or IPO, what I try to do with my companies is we aim for an IPO, which also makes you into a better and easier M&A candidate. Good. A few words on fundraising. Depending on how much capital you're raising, you have different kinds of fundraising strategies, but the starting point with communications with investors always is the investor presentation and the financial plan, and there's a separate presentation from me in a few minutes on that. And then what I also emphasize is, hey, once you have the context ready and up and running, what you also need is presentation skills. So it's not what you present, but it's how you present things. And I call it the words and the music and dance. So you need that just as much as you need the context in your presentation. Let out your energy, let out your charismas, let out your personalities, and influence your investors through presentation skills. Good. Moving on. Cap tables. Make sure that you have a fully diluted cap table ready whenever needed. Cap tables can get pretty complex, but there is a simple way of doing them. Starting, it's one Excel sheet. It gets bigger every time something happens. You start with the founding stage of the company. You have a certain number of founders. You have a certain number of shares, price per share. And every time when you have something happening which relates to equity, you either add columns or you add rows. And after 2 or 3 or 4 financing rounds, it gets pretty complex because you may have equity, you may have convertible debt, you may have interests and whatnot. And the way to communicate the cap table really is that you keep sense of your cap table from day one. And whenever something happens, you just build on that Excel sheet. Good. Then there's something called a term sheet. Many of you have already raised funding. You already know what a term sheet is. For me, there's a couple of things. For me, it's not actually about valuation because you will be valued at a market price. So if you get a term sheet from 3 investors before the end of the year, the value ranges will be very, very close to each other. So I would not even bother about thinking in advance what your valuation could be because the market will speak, and let the market speak. So there are other things that are much more important than the term sheet than just valuation. A couple of things to be aware of is founder vesting. Do you have to earn your shares again over 3 years or 4 years? I would recommend you don't accept that kind of a clause. Or what I see sometimes is a forced exit clause. What it means is that 5 years down the road, the investor gets to decide to whom to sell the company and at what valuation. So the bottom line here is that the investors will try and convince you, and they will try and tell you that, look, there's an industry standard term sheet, and what I'm telling you is no, there isn't. The point is that every single paragraph, sentence, word of the term sheet is something that you should understand inside out and negotiate. And ideally, you have a venture capital lawyer that helps you with the term sheet negotiations. There's a dramatic difference between what many VCs call as an industry standard term sheet compared to what is mine, founder-friendly term sheet. Point made, I hope. Be careful out there. Be ready for due diligence. There's business due diligence, there's technical due diligence, there's legal due diligence, there's financial due diligence, and there could be patent searches on your IP. All of this will take time. And just be sure that you've already prepared your electronic archives for any kind of a due diligence process that you may be facing with a VC. I'll give you a few examples on technical due diligence, which is unusual, but it does happen. In a recent case, a few years ago, we were negotiating with a top-tier European VC about a 5 million investment for a pre-money valuation of 20, and they started doing technical due diligence. They sent an expert to take a look at the source code of our software, and the expert came back and said, look, the architecture does not scale. We had 6 weeks remaining, and of cash remaining, and what did the VC do? They said, look, it seems like it'll take time to fix the architecture. We're fine with that, but we're going to lower the pre-money valuation from 20 to 17.5. And with a few weeks of cash remaining, we couldn't do much about it. So just be aware that there are many, many kinds of due diligences out there, which may take time, and you need to be prepared for that. Shareholders agreements, they can get very complex. Again, it ties into your investor presentation. It ties into the financial plan that you'll be presenting. And I've sometimes seen that the investor presentations, and especially the financial plans, they get to be appendices of a shareholders agreement. So be careful with the financial plan. Be careful with the numbers on what you're showing, because they may wind up being a corporate governance.
5 minutes left, Mikko.
So let me start with. Thank you, Perrine. I think we're in good time now.
And for the audience, you can already ask your questions in the questions window.
Yes. A few words on corporate governance. When you go to a board meeting as a CEO and often as a founder, in my mind, for you, every single board meeting is much more than a board meeting. You're actually fundraising with your existing investors. So just keep that angle in your mind. And then my experience with boards, I serve on the boards of 8 venture capital backed companies right now. Most of my time during the last 25 years in boards, it has gone to strategy, and especially to go-to-market strategy. So the subtle point that I'm making here is that you are now thinking about some kind of a go-to-market strategy, which the investor wants to hear. But my bet is that the go-to-market strategy will evolve over time. Sometimes there are subtle changes. Sometimes you have to do a full pivot in order to find a new direction. On exits, yes, exits do happen. And even at a seed stage, even at a pre-revenue stage, my thinking about exits, I would not spend too much time on rethinking an exit strategy. What I would focus on is building a rapidly growing company that grows 50%, 100% per year, and at some point reaches profitability. And once you do that, you will automatically become an exit candidate, and there's a market price for your company. Having said that, some investors will ask you, well, what do you think of an exit? And if you do some superficial analysis on who your prospective buyers could be and why would they buy you, and have they done previous acquisitions of venture capital-backed companies, then you may want to mention 1, 2, 3 names of potential exit candidates. Good. This was my first part. I'm going to hold my breath for a while and happy to take now questions for the first part. Thank you.
Thank you, Mikko. Are there any questions to Mikko? Please ask your questions in the questions window. We can also go straight to the second part, Mikko, and take all the questions after, which maybe gives time to the audience to think about their questions. Please ask your questions in the questions window, and please be concise and short in the questions, so we have time to go through most of the questions. So I would go on with your presentation now.
Great, we'll do that. So let me go back to full screen mode. Here's one of my companies, coming back to the last point about exit. I started working with them in 2015 when they were at a pre-revenue stage, and we raised about 500,000 of seed capital when it was pre-revenue stage. And I'll show you some of their slides from their investor presentation. And in 2016, they hit their plan of 300,000. And in 2017, they hit their revenue plan. They doubled it to 700,000, and they were acquired for 20 million. And so the point here is that these things do happen. The faster you grow, the more faster you'll become an exit candidate. Moving forward, what I'm going to introduce next is my 10-point investor presentation framework. And the only objective that I have with my kind of a presentation is the following. Most VCs will want to see the presentation, your presentation, well in advance of agreeing to meet you. So what you need is the kind of a presentation that you can pretty freely send to any potential investor without having an NDA in place. And that presentation, it needs to communicate to an outside reader because you're not there to talk through it. So I'm encouraging you to think about your investor presentation as a marketing document which an external reader is able to understand. And the objective of your investor presentation, let's think about it. It's pretty simple. It's not a company presentation, it's not a product presentation, but you're there to sell new shares of your company to new investors. So this is the angle that I've taken in my little 10-point framework. The first 2 slides are important. It even starts with a title page. And here's an example of a title page of a company that said that, look, 55 seconds a day will improve your sales performance by 20%. The point here is that a VC may get 10, 20 presentations every single day, but they don't have time to look at more than 3 presentations. So starting with the title page, you need to sell yourselves, you need to communicate with your title page in order to make sure that the VC will start to take a look at your presentation. After the title page, what happens then? What I recommend is that you have an overview slide. It's a mini story of your investor presentation. It's the most difficult slide of all to do, but if you do it correctly, you can use the overview slide for a 30-second elevator pitch. But interestingly enough, it's also the agenda for your 1-hour meeting with a VC, because all of your other slides, all they do is they support the mini story and the framework that you have in your overview slide. And once the overview slide is simple enough that when you take a taxi to the airport and your taxi driver understands your overview slide, then you know that you're ready to pitch. So this is a structural thing that I recommend that you do and think about, is an overview slide. I usually don't see it when I get presentations, but the companies that I'm involved with and the companies that I coach and mentor, I highly recommend to think about structurally having an overview slide. And here's a real life example of a software company in a pre-revenue stage on how they did their overview slide, and eventually they were able to raise 500,000 of seed capital. They started with the problem, they went on to the value proposition, a little bit about the team, then the market, the IPR, a bit about technology, and the funding need. And then on the right-hand side, you could see the logos where they were expecting to get their first revenue from, despite being a pre-revenue stage company. I'll show you two more examples. Here, you will find the same 7 logic points, but they are just structured in a different way. There's a little bit about the company, a little bit about the opportunity, including the problem, the value proposition, something about the market, and something about the funding need. And then a third example of an overview slide would look like this. So I leave it to your own imagination how you build your overview slides, but pretty much these 3 overview slides, they all communicate the same thing about the problem, the value proposition, the ROI, the team, the funding need, and the financial stage where you are with your sales and your pipeline. The mini story, if you will. A few words about the team slide. At the end of the day, it's the team that investors invest in. So you need to position the team in the best possible way in your investor presentation. Personally, I don't like pictures, but many of you will choose to have pictures. If you do, then make sure that you all go to the same photographer and you have the same background and they're professional looking pictures. But I don't think you need them at the first stage. But what you do need, you need to communicate why is your team the best team in the world to solve a certain problem in the marketplace. And an interesting way of starting the title of your team slide is to say, hey, I have a five-person management team, and in combination, we have more than 100 years of domain experience. So you on the title already, you're setting an expectation, and you're bringing forward your combined understanding of the ecosystem. And one of the points that I'm structurally making is that the titles themselves should communicate. So don't have a title that says my team, but rather have a title that says, look, here's a winning team with 100 years of domain experience. It already communicates on a much higher and better level than just saying that, look, here's my team. And this is a great place for you to also mention whether you have any C-level management team recruitments ahead of you. You may be recruiting for a CEO, you may be recruiting for a VP sales, and this is the place to mention that. So that together with your existing team and your new to be hired members, you have what is called a full management team, which is ready to be funded and which is ready to execute. One of the core approaches that I have in investor presentations is I like to build the stories bottoms up. And what do I mean? What I'm interested in is taking a typical customer that you have or a pilot that you're already speaking with and tell me everything you can about the problem that your client has. What is the real life problem that your client has, which you're solving? That's the starting point. And that's where it gets interesting. And then what is your value proposition to solve the problem? What is your value proposition? It's not the features and functions of your product. It's rather the value proposition that you have to solve the problem. And then the third point, what is the ROI for the customer? So if the customer spends 100,000 euros with you every year, how soon does that 100,000 investment pay itself? Is it 3 years, a year, 6 months, 6 days, 6 hours? It can be done. And at the end of the day, in my mind, all of you are in the ROI business. There's an ROI for the customer when they buy product and service from you. So think about that. It's not easy to do, but it can be done. And initially, don't spend more than half an hour thinking about it. But as you get closer and closer to your customers, speak about the ROI with your customers, because they will certainly know what the ROI is. For example, if you're in the business of selling 500,000 or 1 million euro software solutions, for sure, the customer has a budget, but in order for the budget to be approved, they have to do an ROI calculation for their management team or for their CEO in order to get the budget to buy product and services from you. So it's a new piece of thinking for many of you, I know, but start with a customer problem, continue with your own value proposition, and then at some point, start to stretch your thinking about ROI for the customer. Because that's something that I would certainly ask from you if I wanted to invest in your company. Good. So this, in my mind, is one of the cores of an investor presentation. A typical customer's problem, value proposition, and ROI. Point made? Good. Moving on. Here are examples of customer problems, value propositions, and ROI. I'm not going to go deeper into them because these slides should communicate to you as an outside reader. Here's another way of graphically showing that this is how the customer previously solved the problem, and now that they're using my technology, suddenly their whole value chain is shorter, and it's a lot more cost efficient, and that there is that ROI. The next step in building the logic of a full investor presentation is the technology. And note, we still are not yet in the product or the features and functions of a product or a service. But this is where you describe your intellectual property. This is where you describe your architecture, and this is where you describe your development plan. And an interesting way of communicating all of this is with a title that I would call High Technical Barrier to Entry.
5 minutes, Nico.
10 minutes? Thank you.
5 minutes, yeah, exactly.
5 minutes, got it. I'm fine with that. So you want to show and establish that there's a high technical barrier to entry, and then even though somebody reverse engineers what you're doing, it's non-trivial for somebody to do that reverse engineering. And if you've taken 20 development years to get there, it'll take Microsoft or another big player 5 times, maybe even 10 times more, because you are so good at it. You're the best team in the world to do that technology, and you understand the ecosystem much better than your big competitors. Here's a nice example of a development slide. And what this company said is, look, I'm looking for 3 million of Series A. I would use 1 million of that for further product development, and I would double my IP with 25 more development years. So there's a couple of things that they're saying here. They're saying that, hey, we already have 25 development years in place, and that's something I would like all of you to have in your slides. Is it 5 years or 10 years or 20 years or even more of development that has gone into your technology, everything included, university research and so on, so on, so on. How many development years do you already have and how many development years are you thinking about adding on during the next year or two or three. Then we go to the product, we go to the features and functions that you have, but I want to see how the features and functions tie in to solving the real life problem that we spoke about a few slides ago. Many of you have very, very complex technologies and very, very complex products. So in those situations, there is an alternative way of starting your presentation. And what you may want to have before your overview slide is, this is what we do. And try and communicate to an outside reader who is not technical, which I'm not, in a way that he or she understands what is it that you really do. Market analysis. Quite often I see presentations that tell me, look, I have a 10 billion market or a 20 billion market. I'm not interested in that, because when I look back at my own success stories, they've all played in small markets, but the markets themselves, they've grown fast, 20%, 50%, 100% per year. So I'm interested in small markets that grow rapidly, and maybe it's such a small market that you could say that, look, in 3 years' time, if I get funded, if I execute, I will be the global market leader in my niche. So here again, I'm turning your logic the other way around, and I would rather see bottoms-up market analysis and not top-down market analysis. Thank you for that. Moving on. Here's an example of a bottoms-up analysis of a small market, 2 billion. But the interesting thing for me was that, look, the market itself, predictive analytics, is growing 30% per year. Many of you would come back to me and say, look, there's no market research. And that's when I clap my hands, because if there's no market research available, then maybe you're one of the first in the world to have found a new problem, and you have the value proposition, and you're about to create a new market. That's when my radar really starts to move, and that's when I really get interested. But again, I'm emphasizing the bottoms-up approach. Go to market. I mentioned earlier, most of my time goes to continuously think about go-to-market strategies. You need to have a go-to-market strategy in place when you go speak with a VC. Here's an example of a scalable business model for a SaaS company. I'm not going to go deeper into that, but I do want to spend some time with a CRM. One of my companies had 1 million euros of software revenue last year, and they are raising 3 million today as we speak. And their argument was that, look, we have 1,000 prospects in our CRM. We've not spoken with them, but we think that they have a potential value of 500 million to us. But of those 1,000, we've contacted 164, and we think the value could be 50 million over a 5-year lifetime of revenue. But hey, I'm thinking about doubling my revenue from 1 million last year to 2 million this year, and I have 15 ongoing negotiations for a total value of 30, and all I need is one of those 15 deals this year, and I will double my revenue. And I hope you get the logic of what I'm trying to communicate here, is that you have your suspects that you've not spoken with, you have your early contacts, and then you have your actual negotiations ongoing. And this is a strong way of communicating your P&L, because I immediately do a tie with a CRM and your profit and loss statement. And if you're not using a CRM software, if nothing else, start using Pipedrive. It'll cost you 8 euros a month, and you could use Pipedrive to manage 2 different things. You could use Pipedrive to manage your marketing and sales qualified leads, but at some point you will have tens, if not hundreds, of investor contacts. And a fantastic way of managing those investor contacts is also through Pipedrive or any other CRM that is out there, and they're not that expensive to use. Here's a pre-revenue company of mine that raised 500,000 with no revenue, and the only thing that they could argue was that, look, we have 5 million in the CRM. There's 450,000 worth of business that we've contacted for. We've made offers for 250, and we're in final negotiations for 100,000 euros of business. and these are the logos. So this was the only way that they could communicate that there's value in what they're doing, and it ties into the profit and loss statements. But I'll be coming back to profit and loss statements. Competitive analysis, this is how I'd like to do them. You're in one column, you choose your features and functions subjectively, you present yourselves the best way you can do, and then you mention your competitors, and they should have a lot of red dots in there. And what you're doing is, in a nanosecond, you're visually saying that, yes, I have competition, I have big competition, but I'm not worried about them because they don't have what I have. But be prepared to have a 1-hour discussion only on this slide at a later stage. But what you're initially doing is you're saying, yes, I have competition, but I'm way ahead of them. Don't worry. I'm not a big fan of using quadrants, which many of you will be using, which are, for me at least, pretty difficult to understand. So I would recommend that you build a competitor slide like this and not use a quadrant. Couple of more points. Uses of funding. If you're raising Series A, I would expect that at least half, if not much more than half, should go into lead generation and sales. It should not go. It should not be 80% R&D and productization, ideally. I've stopped using the term marketing because, for me, it's more about lead generation, and many of the marketing themes from 10 years ago, 20 years ago, they're not relevant in the era of social media marketing, which is all about lead generation and measuring the efficiency in generating leads that convert to eventually to sales through the marketing qualified pipeline, through the sales qualified pipeline. Then the financial statements. Most presentations that I get, they do not have a financial statement, but in my mind they should. And I make a very, very clear link, as I've said many times, between the CRM and your P&L. And here's an example, a real life example of a company that had 600,000 in revenue, and they're demonstrating that with 3 million of funding, this is where they would get in 19, 20, 21, and 22. But behind this simplistic chart, there's a very, very complex Excel model with headcount, P&Ls, balance sheets, cash flow statements, and so on.
Mikko, could you please wrap up so we have a bit of time to take some questions?
Yes. For strong companies out there, what you could do, in addition to modeling your Series A, you could already model your Series B. And you could tell the investor that, look, 18, 24 months down the road, I'm going to raise 5 to 10 to 20 in my B round, and this is where it'll take me. So it's an idea for those very strong companies out there that are already revenue generating and you have your strong pipelines. SaaS businesses, there are many SaaS businesses here today. Think about doing a SaaS performance exam. It's pretty simplistic to do, and you should be able to pick it up from this slide. I'm not going to go deeper into this slide now. In summary, the only thing that I need to make up my mind if I was investing in you, and if I decided to meet you or not meet you, I would look at the overview slide, which most presentations don't have. I would recommend you do. I would start with the team slide, and then I would go into the problem, value proposition, ROI logic. Then I would go into the CRM, the pipeline, and the financials. And again, emphasizing that most presentations don't have the financials. But if I had a presentation that had a good overview slide, good financials, and the other points that I'm mentioning here, based on that information, I would be able to do a decision in 3 minutes or less whether I want to meet you or not, which is why I'm overemphasizing that the slides need to communicate to that outside reader, because it's based on those slides that you get to meet them or not. So I'm gonna stop now. Thank you.
Thank you so much for the audience. Be aware that we are going to you're going to access this session for replay from tomorrow on, I think, on our platform, and we will share the presentation with you after the webinar and some documents Miko prepared. So don't worry too much. I'm going to go through questions. Please do ask your questions in the questions window. Miko, what do you consider to be the most difficult step to take between seed and Series A investment?
Right. I think that's an excellent question. And some of you may be pre-revenue stage. Some of you may be already, into first revenue. If you are in a revenue generating stage, there's a clear value inflection point. But if you don't have revenue, then it comes back to the CRM, it comes back to the pilot, even a free pilot that is not paying you, but the free pilot will tell you what the problem is, what your value proposition is, and what the potential ROI is. So those are the things that I would think about as you go from seed to A.
Thank you. Is it advisable for a startup to show a 5-year projection when they are currently raising 500K, for instance?
Right. And my short answer is no. What I would do is I would show 3 12-month periods, and then maybe do what I showed earlier, do a Series B round, which takes then you to year 4 and year 5. But in my mind, my focus is on the next quarter, the next 4 quarters, and I don't need year 4 and year 5. I would recommend big emphasis on the first year, and then year 2 and year 3 are interesting, but nobody really knows where you're going to be 18, 24 months down the road. So I think 5 years is overdoing it.
What valuation method can you apply a 3-year-old company which is still losing money?
Right. Excellent question. I love the question. I've served on the boards of 100 companies. More than 90 of those 100 were unprofitable, were making a loss, but they still had great values. So your valuation will correlate directly with your revenue, and there's a revenue multiple. It may be 10 times revenue, it may be 20 times revenue. But then you ask me the question, what if I have no revenue? How do you value my company? And that's when I say that, look, I have 5 million in my CRM. I'm speaking with customers for about $1 million of sales. And next year, I think I'll do 500,000. And because my CRM is so close, the year after that, I think I'll be doing 2 million. So through the CRM, I'm trying to say that, look, I will make a lot of revenue next year and even more the year after. And I'm trying to convince them that we should use this year's or next year's revenue as the basis for valuation discussion, and then use a revenue multiple, not from this year, or use a revenue multiple from historically, but through the CRM position strong revenue growth, and ideally negotiate and use next year's revenue as the basis for valuation. But simplistically put, it has nothing at all to do with profitability. It has a lot more to do with how fast you're growing. Are you growing 30% per year or 50% per year, or are you doubling revenue every year? And then it correlates directly with your revenue.
We have several questions about the COVID situation. How do you pitch to investors at the moment?
Yes. So again, a very relevant, very timely question. And there are a couple of reactions that I have. One of them is that if I think of my 8 companies, for 2 of them, COVID actually increased demand. So they're doing even better than they were doing before COVID because of the space that they're in. And 2 of my 8 companies are in deep trouble. And the others, for all of the others, we've had to readjust the budget for the remaining 6 months of this calendar year. So that's where I am with my 8 companies. But then there's another aspect to that question, which is fundraising. I think the question that you're asking is the following: what shape is the European venture capital funding taking? Is it a V shape or an L shape or something in between? And what I'm seeing in China, where they measure weekly venture capital activity, that in China, it was a very clear V-shaped curve when the venture capital investing came back. But there were changes in sectors, and I'm expecting venture capital investing in Europe to come back with one caveat, and the caveat is the following. The VCs, by now, they should have taken the analysis of their existing portfolio, so they have to start investing in new companies because of their own business logic. They have to continue investing in new companies. But being in Europe, I would expect things to slow down in July, in August. And what I'm seeing is typically in Europe, you have to be ready to start fundraising mid-August, and then you aim to close your round before end of the year holidays, or you start fundraising end of January, early February, and you try to close your financing round end of June, July. So I would say that from my little perspective, most of the fundraising gets closed either just before the summer holidays or just before the end of the year holidays. So there are two funding seasons, if you will. And what I'm recommending for all of you is during the next 4 to 6 weeks, get your investor presentations ready, get your financial models ready, do pre-marketing and testing, and then mid-August, end of August, be ready to go full out and close your rounds in September, October, November, latest in December.
Okay, great for this very practical tip. What is the most effective way to find a strong investor?
Right.
What would you recommend?
Yes. So again, a great question, to the point question. I like the question. Most investors, even VCs, they are what I call follow-on investors. So what you need to do is you need to find a lead investor. If you're raising 5 million, find a lead investor that takes 1 million or even 2 million of your 5 million. And if you find a lead investor, you will get all of the follow-on investors that you ever need, and your fundraise will be oversubscribed. So it's the point is find your lead investor from somewhere. And it's like dominoes. The lead investor is the first domino piece. You find the lead investor, everything else will come in place. Having said that, you need to think about your fundraising strategy. If you are a medical device company or an e-health company, then it's not a deal for a generalist business-to-business software VC, which most VCs are. So you need to do research in advance on which VCs you want to speak to. Would they invest in your sector or not? Or do you want to raise an angel round instead of a VC round? The largest A rounds that my company, angel rounds that my companies have raised, one of them raised they raised 3 million euros from 55 to 60 angel investors. So think about fundraising strategy, who your prospective lead investors are, and whether you want to raise a late angel round or you want to raise an early A round.
We're going to take 1-2 questions. And when should I say no to an investor?
Right. I think I covered that. And again, a great question. I think I covered that when I spoke briefly about term sheets.
Yeah.
And for me, term sheets are not about valuation because there's a market price for what you're doing, but it's the control terms that the VC may want, and you need to negotiate. And sometimes you need to negotiate very hard because you don't want founder vesting for the next 3 years. And I would recommend you fight hard against if a VC suggests founder vesting. Or if there's what I said, the forced exit clause, you don't want to give control of selling your company to an outsider. So it's these kinds of things that you need to be aware of.
Mikko, for a company, because now we see a lot of in elevator pitches or like 3-minute pitches. What is the most important to highlight, like the story or put some financials? What do you have to focus on?
Right. So here's my recommendation for a 3-minute elevator pitch. You need only one slide. It's your overview slide. It's the same slide that you will use for your 1-minute elevator pitch, for your 15-minute pitch, for your 1-hour meeting. And suddenly it's not about the slide anymore or the context of the slide, but it's your personality and charisma and your energy that needs to come across. So it's a combination of the context of the slide and your personality. That's how you win the audience. It's the song and the music and the dance that I mentioned earlier. What I'm personally trying to do, and I've tried that a few times, is to speak without any slides. And because all of you know the overview slide inside out, what I'm suggesting to strong presenters that are here today, think about presenting your overview slide for 30 seconds or a minute with no slides. I think that's the best possible kind of presentation, and then really let your energy and your personality come across. You don't need those slides. Point made?
Yes.
Good.
Okay, thank you so much. It's almost 5 o'clock, so I'm gonna thank you. I'm gonna thank the audience, and please give us some feedback. A very short feedback survey is gonna pop up on your window. Tell us what you thought about the session and what you wanna listen to in the next month, so we can also tailor these sessions to your needs. I want to thank again Mikko for his time and his expertise. We are going to share the documents with you after this session, so you'll receive an email, I think, tomorrow. And I wish you all a very nice afternoon. Bye. Bye, Mikko.
Goodbye. Thank you, everybody. I really appreciate your questions. They were all spot on. Bye-bye.
Ciao.